Introduction: Decoding the Market's Whisper in a Radically Shifting World. Have you ever felt the ground shift beneath your financial plans, wondering if yesterday's truths still hold sway in today's volatile economy? The late economist John Maynard Keynes once observed, "When the facts change, I change my mind." What do you do, sir? This timeless insight underscores the importance of adaptability, especially in a world where the rules governing markets are constantly evolving. Financial success now demands a keen ear for market signals, a sharp eye for emerging risks, and the wisdom to pivot when paradigms collapse. Lawrence G. McDonald's insights in How to Listen When Markets Speak provide a masterclass in navigating the unpredictable terrain of global economics. This book unravels how the end of the Cold War reshaped economic systems and highlights how global investment strategies must evolve to keep pace with seismic changes. Let's explore these lessons, charting a path through economic myths, market opportunities, and the era of unprecedented uncertainty. As Warren Buffett famously quipped, "Risk comes from not knowing what you're doing." Understanding these market dynamics could be your compass in the financial wilderness. 1. The end of the Cold War and global economic shifts. The collapse of the Soviet Union in the late 1980s ushered in a transformative era, redefining global trade, politics, and markets. The victory of capitalism seemed absolute, paving the way for globalization and the dominance of free markets. However, McDonald highlights that this era also sowed the seeds of financial instability, creating new risks such as uneven wealth distribution and over-leveraged economies. To thrive, investors must understand the geopolitical forces that continue to influence market behavior. 2. Central banks and their expanding role. Central banks have emerged as economic powerhouses, shaping financial cycles through policies like quantitative easing and interest rate manipulation. These interventions, while stabilizing in the short term, have created unintended consequences, such as asset bubbles and economic distortions. McDonald's analysis sheds light on how central bank strategies, like the Federal Reserve's recent policy shifts, demand a deeper understanding of their long-term market impacts. 3. The energy revolution: fossil fuels versus sustainability. The pivot from fossil fuels to sustainable energy sources marks another monumental shift. As climate change drives global policy changes, investors must adapt to the evolving energy landscape. McDonald discusses how traditional energy markets are being disrupted by renewables, creating opportunities for forward-thinking investors. Recognizing these trends isn't just smart investing, it's a necessary adaptation in a world striving for sustainability. 4. The rise and fall of speculative bubbles. From the dot-com bubble to the cryptocurrency boom, financial history is riddled with speculative frenzies. McDonald provides a detailed examination of how these bubbles form and burst, emphasizing the importance of distinguishing between short-term hype and long-term value. As Sir Isaac Newton lamented after losing a fortune in the South Sea bubble, "I can calculate the motions of heavenly bodies, but not the madness of people." McDonald's insights aim to help investors avoid such pitfalls. 5. The shift toward hard assets. In today's volatile market, there's a noticeable move toward tangible investments like real estate, commodities, and infrastructure. McDonald argues that these hard assets offer stability amidst the speculative frenzy dominating modern markets. Understanding why investors are prioritizing tangible over speculative investments can help align your portfolio with enduring value. By listening to the whispers of the markets, discerning patterns, and recognizing emerging opportunities, you can thrive in an economy defined by flux. As McDonald suggests, adaptability and informed decision-making are your greatest allies in navigating this new economic landscape. If you found these insights enlightening, don't forget to like, share this knowledge with your network, and subscribe for more deep dives into financial wisdom. After all, as Benjamin Franklin aptly said, an investment in knowledge pays the best interest. About the author. Lawrence G. McDonald is a former trader at Lehman Brothers and an acclaimed authority on risk management, market behavior, and financial crises. With his extensive first-hand experience, McDonald has become a sought-after speaker, sharing insights into the complexities of financial markets and the lessons learned from his career in the high-stakes trading world. He gained widespread recognition for his best-selling book, A Colossal Failure of Common Sense, which provides an insider's perspective on the dramatic collapse of Lehman Brothers, a pivotal moment in the 2008 global financial crisis. McDonald's expertise continues to influence discussions around market risks and financial resilience. Chapter 1. A New Lens on Market Dynamics. In a rapidly changing economic landscape, where age-old financial rules may no longer hold sway, understanding market signals is more vital than ever. Lawrence G. McDonald's How to Listen When Markets Speak unpacks the myths, risks, and opportunities within an evolving global economy, shedding light on how modern investors can navigate unprecedented shifts. The collapse of traditional paradigms, driven by political upheavals and environmental imperatives, demands a recalibration of investment strategies. As markets evolve, the book offers critical insights to avoid financial pitfalls while seizing emerging opportunities in a radically transformed world. Tracing the roots of economic transformation. The journey begins in the 1980s, a decade marked by Cold War tensions and transformative political strategies. President Ronald Reagan's rhetoric, labeling the Soviet Union the evil empire, reflected broader efforts to exploit the USSR's systemic weaknesses. Despite its vast nuclear arsenal, the Soviet Union faced an economic collapse fueled by inefficiencies, military overreach, and events like the Chernobyl disaster. By the late 1980s, Gorbachev's disarmament dialogues with Reagan marked a turning point, culminating in the USSR's dissolution in 1991. This shift from a bipolar to a unipolar global order under U.S. dominance had profound implications for global trade and finance. Globalization's economic surge. The end of the Cold War and the fall of the Berlin Wall ushered in an era of unprecedented global trade. Between 1990 and 2022, international trade expanded from under $5 trillion to $28 trillion. The U.S., leveraging strategic alliances such as those with Saudi Arabia, managed to stabilize global oil prices, solidifying its economic leadership. This period also heralded a phase of disinflation, marked by declining interest rates. U.S. Treasury bond yields dropped dramatically, encouraging investments in higher-risk assets and fueling an extraordinary bull market. A bull market boom. The S&P 500, emblematic of the U.S. financial market's growth, soared from 323 in 1990 to a staggering 4,800 by 2021. This bull run reflected investor confidence in a stable, unipolar economic order. However, this confidence is now challenged by the emergence of a multipolar world, where rising geopolitical tensions and shifting alliances could disrupt long-standing economic patterns. McDonald's insights emphasize the necessity for investors to reconsider traditional strategies in light of these changing dynamics. Navigating new economic realities. The book explores pivotal themes, including the evolution of central bank policies, the shift from fossil fuels to sustainable energy sources, and the rise of speculative financial bubbles like cryptocurrency. Investors are increasingly drawn to tangible, hard assets, reflecting a shift in market sentiment toward reliability and stability. McDonald highlights these trends as critical for understanding future opportunities and risks in a volatile economic environment. Redefining investment strategies. How to Listen When Markets Speak provides a comprehensive guide for navigating the complexities of a reshaped global economy. By tracing historical developments and analyzing current market dynamics, McDonald empowers readers to anticipate shifts, mitigate risks, and capitalize on emerging trends. As the world transitions from unipolar stability to a more fragmented economic order, this book serves as a crucial resource for making informed, strategic investment decisions. Chapter 2. The Interplay of Central Banks and Market Cycles. Central banks play a pivotal role in the intricate dance of economic stability and risk, significantly shaping financial market cycles. By managing policies and interest rates, they aim to stabilize economies, though their interventions often sow seeds of long-term instability. The 1980s provide a crucial starting point, where Japan's rapid ascent to economic prominence through manufacturing and exports led to an asset bubble. The 1985 Plaza Accord, intended to devalue the US dollar, inadvertently spurred the Japanese yen's appreciation, prompting drastic rate cuts in Japan. While this mitigated immediate recession risks, it fueled a bubble whose burst reverberated across global markets. The ripple effects of economic crises. Japan's experience influenced neighboring Asian economies, collectively known as the Asian Tigers, South Korea, Taiwan, Hong Kong, and Singapore. These nations adopted Japan's model, initially achieving robust growth and attracting Western investment. However, the 1997 Asian financial crisis exposed vulnerabilities, as capital flight and currency devaluation shook these economies. Global markets faced turbulence, underscoring the interconnected nature of financial systems. One critical intervention during this period was the Federal Reserve's involvement in the 1998 bailout of Long-Term Capital Management, LTCM. The hedge fund's near collapse posed a systemic risk, marking a significant escalation in central bank interventions in financial crises. The era of intensified interventions. The early 2000s saw another wave of central bank activity. The dot-com bubble burst, compounded by the September 11 attacks, prompted aggressive interest rate cuts by the Federal Reserve to stabilize markets. While these measures provided temporary relief, they contributed to conditions leading to the 2008 financial crisis. In response to this crisis and later to the COVID-19 pandemic, central banks adopted extensive quantitative easing and maintained low interest rates. These strategies buoyed asset prices but also widened economic disparities and inflated public debt, creating new risks for long-term stability. The accumulation of systemic risk. With each intervention, a pattern of moral hazard emerged. Financial institutions and investors, anticipating central bank bailouts during crises, engaged in increasingly risky behavior. This cycle has entrenched expectations of support, fostering a precarious financial ecosystem. The history of boom, bust, and bailout highlights the complexities of central bank involvement, showing how immediate stabilization efforts can inadvertently encourage systemic vulnerabilities. Balancing stability and resilience. The key takeaway from this historical pattern is the need for balanced economic policies that prioritize long-term sustainability over short-term fixes. Central banks must navigate the delicate balance of intervening to stabilize markets without incentivizing reckless behavior. The accumulation of public debt and economic disparities highlights the importance of cautious governance to safeguard financial systems against future crises. Toward a sustainable economic future. The narrative of central bank interventions underscores an enduring lesson: the critical importance of fostering resilience in financial markets. Policymakers must adopt strategies that not only address immediate crises but also build a framework to prevent excessive risk-taking. As history reveals, achieving economic stability requires vigilance, prudence, and a commitment to long-term planning, ensuring that future financial systems are robust against the challenges ahead. Chapter 3: A New Perspective on Financial Markets. In How to Listen When Markets Speak, Lawrence G. MacDonald delves into a rapidly transforming global economy, where traditional financial principles may no longer hold. With economic paradigms shifting due to geopolitical changes, technological advances, and energy transitions, investors are urged to adopt a more discerning approach to navigating these complexities. MacDonald emphasizes that understanding the nuances of global market dynamics is essential to protecting assets and identifying sustainable investment opportunities in this uncharted territory. The end of the Cold War and economic transformation. The collapse of the Soviet Union in 1991 marked a seismic shift in global economics, transitioning the world from a bipolar power structure to a predominantly US-dominated system. This period saw an unprecedented expansion in global trade and a shift toward economic liberalization. The US leveraged this new landscape by forging strategic alliances, notably in energy markets, solidifying its economic dominance. These changes ushered in an era of disinflation, characterized by falling interest rates and booming financial markets, which saw assets like the S&P 500 rise dramatically. However, the geopolitical climate today suggests a move toward a multipolar world, signaling the need for re-evaluated investment strategies. Central banks and economic cycles. Central bank interventions have played a defining role in shaping economic stability and risk over decades. From Japan's post-Plaza Accord asset bubble to the Asian financial crisis and the long-term capital management bailout, such actions have both stabilized and destabilized markets. In recent times, measures like quantitative easing during the 2008 financial crisis and the COVID-19 pandemic inflated asset prices but also exacerbated economic disparities and debt burdens. MacDonald highlights the recurring pattern of moral hazard, where expectations of bailouts foster risky financial behavior, calling for policies that balance immediate relief with long-term resilience. The energy sector, evolution and challenges. The energy markets have been at the heart of economic shifts, with dramatic fluctuations shaping industries and investment strategies. MacDonald uses the example of Chesapeake Energy's rise and fall to underscore the risks of high leverage in volatile markets. As the world transitions from fossil fuels to greener alternatives, nuclear energy emerges as a pivotal player, though underinvestment and skill shortages hinder its growth. Balancing environmental goals with economic realities requires a strategic, measured approach to energy investments, ensuring both sustainability and stability. A call for strategic investment. MacDonald concludes by urging investors to stay attuned to these transformational changes. From the evolving roles of central banks to the challenges in energy transitions and the shifting geopolitical landscape, the future of financial markets will demand adaptability and foresight. Investing in a mix of traditional and alternative assets, while staying grounded in pragmatic strategies, is crucial for navigating the uncertainties of a radically reshaped economy. This comprehensive understanding not only secures financial stability but also ensures preparedness for the economic complexities of the future. Chapter 4. Navigating the Psychology of Financial Bubbles. Understanding the psychology of financial bubbles is critical in managing the inherent risks of volatile markets, particularly in emerging sectors like cryptocurrency. The case of Jane Street Group highlights the intricate dynamics within modern financial entities. Operating as a quantitative trading powerhouse, Jane Street handles $17 trillion in annual trades, driven by a decentralized, innovative structure staffed by thousands of computer scientists. However, its unique environment can foster speculative risks, illustrating the complexity of balancing innovation with stability in contemporary finance. A cautionary tale in cryptocurrency. Sam Bankman-Fried's trajectory underscores the fragility of speculative markets. Starting his career at Jane Street, the MIT graduate later orchestrated a $40 billion cryptocurrency disaster, exemplifying the volatile nature of digital finance. His rise and fall reflect how ambitious ventures in speculative markets can lead to dramatic financial failures, serving as a cautionary tale for investors drawn to high-risk opportunities in the evolving cryptocurrency landscape. Historical echoes of financial mania. The concept of market bubbles, rooted in historical episodes like the 17th-century Dutch tulip mania and the dot-com bubble of the early 2000s, demonstrates how collective psychology and government policies can detach valuations from economic fundamentals. Freud's theories on group psychology provide insights into the crowd behaviors driving these phenomena. These bubbles often emerge when liquidity and speculative narratives override rational economic analysis, leaving devastating impacts on markets when they burst. The rise and risks of cryptocurrency. Born from the 2008 financial crisis, Bitcoin introduced a decentralized alternative to traditional banking, leveraging blockchain technology to create a secure, finite currency. Despite its transformative potential, cryptocurrency markets have become breeding grounds for fraud and speculative excess. The Bitcoin mining process itself illustrates the increasing difficulty and diminishing economic viability of creating new coins, reflecting the resource-intensive nature of this digital frontier. Price volatility and regulatory challenges further compound the risks in this space. Lessons from speculative markets. As digital currencies reshape the financial landscape, their susceptibility to speculative bubbles demands caution and informed decision-making. History demonstrates how bubbles can redistribute financial resources, often diverting them from stable investments to inflate speculative assets. While blockchain and cryptocurrencies hold revolutionary promise, their inherent volatility necessitates a pragmatic approach, balancing innovation with careful market analysis to mitigate risks and avoid the pitfalls of financial mania. Chapter 5. The DRC, a resource powerhouse in the green economy. The Democratic Republic of the Congo, DRC, has become pivotal in the global push towards sustainability and high-tech innovation, holding approximately 70% of the world's cobalt reserves. This mineral is crucial for technologies like electric vehicles and smartphones. Dubbed the Saudi Arabia of the green and high-tech industry, the DRC's resources are indispensable to the modern economy. However, the local population sees minimal benefits, grappling with humanitarian crises and environmental degradation fueled by resource exploitation. This scenario underscores the disparity between resource wealth and local economic development. Shift toward hard assets amid economic challenges. In response to economic uncertainty and the diminishing appeal of speculative investments such as cryptocurrencies and meme stocks, investors are redirecting their focus toward hard assets. Charlie Munger, the renowned investor and Warren Buffett's partner, championed this approach, advocating for patience and a preference for undervalued, tangible assets. Munger believed in taking a contrarian stance during market downturns, viewing such periods as opportunities rather than setbacks. This strategy gains relevance in inflationary periods, where commodities like cobalt, copper, and other essential materials become increasingly attractive as stable investments. Commodities, pillars of green technology. The demand for commodities is escalating as they play a central role in green technology and sustainable energy solutions. Metals like copper, essential for electric vehicles, which use significantly more copper than conventional cars, and rare earth elements needed for renewable energy systems, are at the forefront of this demand surge. These materials are indispensable in transitioning to a sustainable global economy, making them a strategic addition to investment portfolios. As inflation reshapes markets, commodities provide a hedge and a pathway to capitalize on the technological advancements shaping the future. Evolving investment strategies for a new era. Traditional portfolio strategies, such as the 60-40 stock-to-bond allocation, are being re-evaluated to include greater exposure to hard assets. This adjustment not only addresses inflationary pressures but also positions investors to benefit from sectors driving future growth, such as green technology and infrastructure. Incorporating commodities into portfolios reflects a shift toward tangible investments that align with the transformative trends of the modern economy, ensuring resilience and relevance in rapidly changing markets. Building resilient portfolios with hard assets. The evolving investment landscape necessitates a focus on hard assets as both a hedge against inflation and a means to capitalize on emerging economic opportunities. Commodities like copper and cobalt are integral to the green energy revolution, making their inclusion in investment strategies a prudent choice. By aligning portfolios with these essential resources, investors can build resilience and tap into the growth potential of sectors poised to define the future economy. In an era of rapid change, such strategic alignment offers a pathway to thriving and dynamic financial markets. In summary, in How to Listen When Markets Speak by Lawrence G. McDonald, we explore how the post-Cold War economic environment and central bank policies have significantly influenced global financial markets and investment strategies. The end of the Cold War ushered in a period of profound economic shifts, marked by the Soviet Union's dissolution and the rise of a unipolar global order dominated by the United States. These changes catalyzed rapid globalization, shaping trade, economic policies, and financial markets for decades to come. Central bank policies have played a pivotal role in shaping market dynamics, particularly through interventions during crises. From the Asian financial crisis to the 2008 meltdown and beyond, these policies stabilized markets temporarily but often introduce long-term risks. For investors, understanding the interplay of central bank actions and economic cycles has become critical for navigating the complex financial landscape of the 21st century. The evolution of energy markets has further transformed investment strategies. With the shift from fossil fuels to green energy, resources like cobalt and copper are now vital for renewable technologies and electric vehicles. This transition underscores the growing importance of hard assets, not only as a hedge against inflation but also as key drivers of technological innovation and sustainable energy solutions. Cryptocurrency and financial bubbles reveal the psychological complexities of modern markets. The rise and fall of speculative assets like Bitcoin demonstrate how compelling narratives can detach market values from economic realities, often leading to financial turmoil. McDonald emphasizes the need for caution and discernment, particularly in markets characterized by extreme volatility and rapid innovation. Amid these transformations, traditional investment approaches like the 60-40 stock-to-bond ratio are being reimagined. Portfolios increasingly favor hard assets, which offer stability and align with emerging economic trends. By focusing on tangible resources essential to modern infrastructure and technology, investors can better position themselves for long-term success. This book highlights the critical need to adapt strategies to contemporary economic realities. By learning from historical market patterns and embracing hard assets, investors can navigate the challenges of a rapidly changing financial landscape with confidence. Strategic thinking and foresight are essential for capitalizing on opportunities while mitigating risks in today's dynamic markets. Thank you for engaging with this summary. If you enjoyed this content and want to explore more insights, don't forget to like, share, and subscribe to the channel. Your support helps us bring you valuable content on investment strategies and economic trends. See you in the next episode.